So the company called Centene Corporation, CNC the ticker. It's established in 1984, but for whatever reason, when I analyze it technically, the information is only from 2002. So probably prior to that, it wasn't public. Maybe it was some kind of acquisition or merger at that particular moment. So that's why we don't see it on technical. It is on my chart. I don't see it anything prior to that. Now, at the moment, it's quite a big company, and in 2020, it was placed on a place 42 in the Fortune 500. All right, it's also included in S&P 500 index. Okay, now and the growth is done in different way of this particular company. The way they do it, they have organic growth, so they kind of expand their services, they expand geographically, but also they grow, and the growth happens much quicker this way by buying other companies. All right, and in 2019 they acquired WellCare company. Now, the reason why I'm pointing exactly to this particular purchase, because they paid $17 billion to buy that company. And if you take and look at the current valuation of Centene Corporation, it's altogether $37 billion. So if you deduct $7 billion out of that, it means that valuation of Centene prior to that has to be around $20 billion. So it means that they actually swallowed the company which is similar size as they were at that particular moment. Maybe they were just a bit bigger than that. And that would be the reason why in 2019, the price of this Centene Corporation kind of dropped down quite a lot, because when investors, they see something like that, when they see that one company kind of buy another company, and especially when they buy something as big as they are, they understand that there could be a lot of problems with that, especially when the company is borrowing a lot of money. And we're going to talk about that a bit later. All right. Now, at the moment, they are also buying some kind of different companies but already for the price of $1 billion or something like that. So it's not as big as whatever they purchased in 2019. And also, when we're going to look at financial statements, we will see how it affects the balance sheet, profit and loss statement, and the main reason for those changes will be this purchase. Okay, and also the good to know that Centene Corporation is not only providing services in the United States, they actually expanded. They don't have huge business overseas, but still they're already providing some services in Europe, in the United Kingdom, and who knows, they might expand that further, and there would be a big business from that part as well. Now, guys, if you want to read more about this, you can go and read in Wikipedia. It's more like about history and what the company does, but also you can go to centene.com. There would be a wide range of services, and they will explain what they're doing. So what I've done, I went to their website, and that's what I saw. So this is what kind of services they provide. Okay, Medicaid, Medicare, health insurance marketplace, military and veterans, correctional healthcare, specialty pharmacy, benefit management, dental, vision, nurse advanced line, after hours support, and other services. I just didn't put everything in here, but you can see that they provide a quite wide range of services. And also, as already mentioned, they mostly, you can see here, they deal with a kind of budget customers, people who cannot pay high premium for private insurance, and the government sponsored services. So, and if we expect that Biden is going to do something about this and he's going to attack the health service, we understand that this particular business is actually going to be pretty stable, because they're not benefiting a lot. Their margin is already quite low because the government controls this part, but the private sector will be affected more. Okay, so we need to be aware of that. It's like our protection plan for this particular area. And I just took from their last report this information because I think it looks really, really fantastic. Look what happens. If we look at the last 3 months, 3 months in 2020 and 3 months in 2019, and that's the changes. The Medicare, this is the revenue. It's not a profit, it's the sales level. But still, we can see from $13 billion, it went to $19 billion. 47% growth. Now, commercial, this is where the private part of there, right? So from 3.5 billion to 4.1 billion, 17% growth. Not that as big as Medicare, okay, but still growth. Medicare from 1 billion to 3 billion, tripled, right? So, and some other services as well. So altogether, it's moved from 18 billion to 28, so 50% growth in one quarter, right? If we compare last quarter in 2019 and 2020. Now, if we look annually growth, so in 2019 and 2020, we see from 51 to 74, 44%, so similar. From 14 to 17, right? So 16%, and from 4 to 11. So it's huge growth, also close to 50%, 49% growth on an annual basis. The question is why? Why do you think the company grew so much in 2020? I already kind of give you a hint before that. So why do you think, how company could be triggered so much when people expected that actually the medical service industry will suffer, but instead of that, in 2020, when this pandemic hit, they made much more in sales than previous year. Guys, can you put in chat? Why do you think it happened? I already explained you that. You just have to repeat what I already said. Can you type it? Correct. Rohan, it's acquisition. Whatever they bought this WellCare company, right? This is the main reason why they increased 50% in revenue. Right? And the thing is actually what also affected the industry in general. They had to reduce some margins. Okay, some services they have to reduce the margin because the cost increased for some places, because they had to pay more money to certain service providers because of the risk which they incur because of pandemic, but also they had all these extra precautions against the pandemic and spreading the virus, which increased the cost as well. Okay, even though the revenue increased, the net profit didn't grow 50% up. It grew, but didn't grow 50%. It grew around 40% in total for the company. Okay, this is information about it. Now let's have a look at Valueline. Valueline, for those who don't know, guys, Valueline is the company which provides analytical research. It's similar to Guru Focus, it's similar to Morningstar, to Bloomberg, right? And the thing why I like Valueline, because they also provide some like information from analysts, not like in some companies where you just see pure numbers and you don't see any overview from the person who actually keep an eye on that particular company for the last maybe several years, right? It's always good to see his kind of insight on that particular company. Now, generally, what is important to see here? First of all, there are no dividends, okay? Personally, I prefer now to buy companies, especially when the time is unknown, to buy companies with dividends. Okay, that's my preference. Here, there is no dividends. Now, when we look at P ratio, here it says 14, but this is report done in the end of December, so there is some time passed already, and we could see here that right now, Valueline tells that P ratio is 12. Okay, and the price is $59, not $63. Timeliness is 2, safety is 3. Which is pretty good, and the target price, so where the Valueline expects this company to be within the next 3 to 5 years, it's actually between $85 and $130. Although in a short period of time, they might see that it can fluctuate between 48 and 126 based on the economical situation, what is happening right now. Okay, now let's have a look what happened within this company for the last several years. And first, we're going to look at revenue. So revenue, it's a sales level. Now, if we start from the very beginning, which we see here, it's $6 in 2004 and $191 right now. Guys, I presume even 16 years passed, but this is a fantastic growth. Right? It's just amazing growth. Now, also, if we look from the earnings perspective, 26 cents in 2004 and $4.70 right now. Okay, so which is 16 times more, right? Nearly 17 times, 18 times. So this is just amazing time. Okay, so in this particular time, more than 20 times actually, close to 18 times. And let's have a look, because for us, it's also important how company is going to manage if there are some problems with economy. Right? And usually the way we do it, we look at the past, what happened in the past. And that's what we can see. We don't see 2000, we see 2008. So let's have a look. So this is the sales level in 2016, $13, $16, $19, $22, slightly drop in 2009, and then start growing again. Okay, and since that time, there wasn't even 1 year when company wasn't growing. Okay, and as we can see, for the last few years, it's moved from $119 in 2016 to $191 in 2020. Now, remember, for us, more important, the net profit, so the cash which company actually generates after all expenses. So let's have a look at the same thing. Now, in 2005, we can see the drop from 31 to 5 cents, quite huge drop. And then we can see a similar drop in 2011. So in 2008, we actually see the growth, and then in 2009, again, a slight drop here. Now, the question is here, guys, when is it is a bad thing when from earnings of 56 cents, it's dropped to 9 cents. But I always pay attention to what revenue happens and also to the debt level. And what do you think, guys, could happen here when the revenue went from $26 to $41, and at the same time the net profit for that year went from 56 to 9 cents? Why did it happen? Who can give me a hint or the idea why was it happening? And look at the next year, it jumped from 9 cents to 72 cents. So much higher, 50% higher than on the previous year. What do you think was happening here? Because it is important that you understand when you see something like that in reports. All right. It's acquisition. Most likely it's acquisition. When you see something like that, you need to kind of understand that, look, if the revenue increases, how can revenue from 26 increase to 41? It's not 10%, right? So it's nearly what, 14, 15. So it's more than 50% growth in sales. It doesn't happen just in organic growth. It usually happens when the company buys something. Now, when the company goes and buys something, do you think they have to do some audits? Do you think they have to do some legal things to check it and etc.? So this process, when you buy other companies, is quite expensive. Usually it costs a lot of money to purchase acquisition, maybe some changes after that in the company. And most likely that's what affected the profitability. Usually it's a lot of costs related to this merger. And as a result, probably that's affected the price. Usually, in order to confirm it, I also go to the debt level, because usually when the company buys something, they borrow money or they increase their shares, right? So that's what we see. If we look at long-term debt, there was $348 million in debt, and then it was 535. So the level of debt increased nearly $200 million at that stage. So at that time, it wasn't as big as now company. So for them at that stage, it was a big number in any way. So that's probably the reason for this drop. So it wasn't bad performance drop. And after that, look at this company, 9 cents, 72, $1.12, $1.40, $2.20, $2.50, $3.50, $4.40, and $4.70 this year. And the company expects around $7 profit in 3 to 5 years. So this is what we can see right now. So definitely I can tell that the company is stable. The company can handle economical kind of downturns. The company grows in sales. The company grows in net profit, so which is good. Okay, also cash flow, we can see growth, although company doesn't pay dividends. And also, if we look, the level of debt increased quite a lot. Now, if we look here, level of debt, we can see that last year it jumped from $6.6 billion to $13 billion. And right now, the total debt is $16.7 billion. And also, what we can see here, the amount of shares outstanding, it used to be 400 million, 15, now it's 580. So why do you think they issued new shares? The main reason they issued it in order to finance that huge purchase, okay, which they did. And personally, I believe it is actually a good move when you're actually issuing more shares in order to buy something rather than Chico, right? Or other companies which borrowed a lot of money, and after that they couldn't serve that debt, and as a result we don't see them on the market right now. They got into liquidation, right? So this company actually issuing more shares and spread the risk among the investors rather than to put everything on existing investors. Okay, so like new investors. Now the margin, return on total capital is 7%. Gain operating margin 5%. That's what I'm saying you. And usually this is the average margin, operating margin for this company. So that's why I'm saying if the politicians start attacking the medical health sector, so they're not going to be after Centene Corporation. They're mostly going to be after the private sector where the high premiums and everywhere else. Okay, so this is kind of the thing. Now, also when we look at this debt, 16 billion, we'll still have to consider if the company can serve that debt. And usually we need to pay attention to the net profit. Now, how much company generates. In 2020, they generated $2.7 billion. So assume that they decide to pay off this debt. How many years is going to take for them to pay it? So we divide 16.8 by 27, roughly it's what, about 7-8 years, right? And especially if we take into consideration next year, this year, 2021, they're already planning to do 3.2 billion and then $4.4 billion. So we can see this growth. We understand that actually company can manage to pay this debt, even if it takes for them 5 to 6, maybe 7 years, they still can do it. All right, so this is kind of the good thing about it. Now, this is from the quality perspective for the company. Let's have a look at valuation. If we look at in general, how much people paying for $1 profit in this particular company, so PE ratio, that's what we can see. The maximum was probably 23 times. The lowest was 9.7, 2009. Right? If we take last few years, it was the highest 22, 14, 16, 17, and last year it was 12.3. And remember that that was a time when they were purchasing this company, doing the big acquisition. People were stressed the most at that particular time, so they paid the least. And the PE ratio, average PE ratio on that year, it was 12, right? And currently, if we look at the current profit, $4.7, correct? And the share price is $59. So it means that, so actually, no, it's last year. So current year is $5.5, 5.5, and the current price is $59. So it's roughly 11 PE ratio. So it's, if we look at present PE ratio, current PE ratio, if we look at the trailing PE ratio, it's roughly 12, something like that. Okay. So this is first part of Valueline report. So let's go look at the second part. So another thing which is also important to see on the serving part of the debt, look how much cash they have right now. They have nearly $13.6 billion in cash. So the total debt is $16 billion and they have $13 billion in cash. So guys, if they require to pay something, I presume they're able to cover part of this debt if they want to, okay, because they have so much cash items on their account. Even though the difference here between current assets and current liabilities is $6 billion. So at least they have $6 billion in this particular situation, but in cash they have nearly 13 billion or more. Now, from the growth perspective, we already saw that it's growing pretty stable, but look at the percentage. If we take last 10 years, in average, the company was growing 23% in revenue and 24% in earnings. Every year, 23 or 24% up. For the last 5 years, the speed of growth in earnings increased, which is fantastic because it means that company optimizing their expense level. So, and they still grow in sales, but also they grow in net profit. Although based on the current situation, what's happening in the market, they reduce their projections. And today I was listening, especially for this masterclass, I was listening their last earnings call, and a lot of institutional investors, they were asking him, give us projections, like exact projection for this service or for this service. And majority of directors, they will tell you, no, wait until the first quarter. At least we know what to expect from Biden and from the general, situation with the virus and the vaccine. So then we'll tell you more in details, what is going to we expecting. So they are not giving you specific wrong projections. They already adjusted them based on the situation which is happening right now, which is good. Okay, and that's why their earnings predictability is 85%. So it means that 8 times out of 10 they're right about their earnings, which is good. So it creates certain stability. We know if they promise something, they're going to deliver that. And they're promising to us $7 in 3 to 5 years. Okay, so but still growth rate is going to be 7 and 13%. It's still good growth rate for company that size. It's actually pretty fantastic. Okay, maybe in the future they start paying dividends, but at the moment they're probably better off pay off their debt. Okay, so this is the best way to invest. And here again, so just to read it, Centene Corporation provides services to government-sponsored healthcare programs targeting underinsured and uninsured individuals. It offers health plan coverage through government-subsidized programs such as Medicaid, Medicare, and state-sponsored programs. Centene also provides specialty services including behavioral health, care management software, correction healthcare services, and pharmacy benefits management. Okay, this is kind of company. So this is a Valueline report. Also, guys, what I've done, I went to Interactive Broker and downloaded their financial statements, at least 2 statements, earnings statement, income statement, in order to show you the growth. You can see that within last year, from 74 billion in revenue, it went to 111 billion dollars in revenue, like in general for the whole company. And also, if we look net income after taxes, so from 1.3 billion to nearly 8 billion in net profit. Although, look at this normalized earnings per share here. If we see here nearly 50% growth here, we don't see that growth. So in earnings per share, we see the growth, but not that big. And the question is why? Because they issued more shares, right? So we can see that from $4.6 per share, it's now $5.8 per share. So it's a bit different because sometimes different, like Valueline tells us 4.7 for the last year, and for this year 5.5, and they're already reporting that for 2020 they have $5.8 in profit. Now, if we look at the balance sheet, the things which I want to show you, that goodwill is increased from $6.8 billion to $18.6 billion. So it's actually $12 billion increase. And remember, I told you that they paid $17 billion for acquisition. So it means that out of this $17 billion, they actually pay for the brand name $12 billion. So the only tangible assets, they purchased $5 billion, but pay for the $17 billion. So that's why what we can see here, that their tangible book value per share, you can see here, it was $8 per share. Now it's went to negative, minus $2 per share. So at the moment, if they try assets, of course, they have certain client base and etc. They probably can negotiate the rates if they decide to go into liquidation, which I doubt, of course. But you need to be aware of it because there is no book value right now there. All right, guys, you understand that. And also, we can see that the long-term debt increased from $13 billion to $16 billion. So it's grew only what, about $3 billion in total long-term debt. So it did increase quite a lot compared to the previous year. And but then in the 2018, probably before they purchased it, they had to get another debt level. So around $7 billion they borrowed here. So 7 billion plus 3 billion, so $10 billion they borrowed, and probably the rest of it they financed by issuing new shares, which we saw increase as well. Okay, so for example, if we have here, no, there is no information proof of stock here. Okay, so but you've seen it. So guys, in any way, you've seen about this company. So I showed you a few parameters. Can you tell me what do you think about this company? Is this company quality company? And if you went through our program, so you probably can put some numbers on it. If this company is undervalued, overvalued, or normally valued, can you please put your decision as well in chat? Because remember, the main kind of goal for this class is not just to give you information, it's to teach you how to assess the financial statements, to learn about it. So if you already have some kind of an idea about this company, good or bad, or kind of undervalued, overvalued, just please put it in the chat. And I'm curious to see your decision. Okay, normal is 4x4, so it means good quality and undervalued. Anyone else? Dmitry, 3x4. Okay, so it's strong but not fantastic quality. Anyone else? Michal, you recently analyzed this company. You have to know that. I could see your report. You provided it, so you have to remember it. So where is your answer? 4x4, correct, absolutely. All right, guys, I just explain you. For the group who answering right now, if you are just new to our master classes, so generally what happens that we analyze company for two parameters, major parameters, the quality of the business. And the quality of the business, it's sustainability of the business, but also we assess it for the growth perspective. We like the companies which have growing sales, which are growing in net profit, which are reducing their debt, which have good management, and all these parameters which creates the company for future, to sustain the company for future growth, which is very, very important, right? So this is talks about the quality. Very often, companies like that, they're overpriced because people, when they see companies like that, they won't pay for them more money. And only sometimes when there is certain issue within the company, or maybe within an industry, or maybe within economy in general, the prices of those companies, of shares of those companies, they drop. And when we see that that kind of good company now sells on discount, we call it undervalued. Okay, so when they sell below the value, and it tells us that it is a good investment right now, because eventually in the future, maybe a few months from now, people will adjust their decision when the problem solves. They're going to pay exactly the same amount of money which they paid before, and that's how we assess it. We look at price to book value, cash flow statement, but also PE ratio. And PE ratio usually paid here for $1 of profit. People for this company paid 16 or 17 or 20 times more, but now they're paying only 12 times. So even if the company keeps the same earnings and then will be adjusted to the PE of 16, so they start paying 16 times more. So it means that our company, our price is going to increase about 40% from the current level. That's how value investors, they make money. That's how we make money. Okay, guys, that's for you if you just new to this type of idea. All right, that's why I was asking our members if you guys believe this company overvalued, undervalued, okay, normally valued. Now this is my result. So the company is 45 by quality, so it's a good quality. Okay, and as we can see, we lost only on that level. But again, we analyzed the debt is servable. Yes, but debt increased a lot, and you understand it why, right? Because they purchased another company, huge company. So this is the main. So for us now, more important, when we know the company borrowed so much money, the question is, can they serve that debt? This is the question which you have to ask. And we know they have, right now, they have $13 billion in cash, they have $16 billion debt, and they have $13 billion in cash. So at least if some debtors will come and demand, they can pay it off because they have so much cash. It's one thing. But secondly, they get about $2.7 billion now net profit. So the question is, usually all this business debt, they can be like increased further, right? So, and if we know that this 2.7, within 4 years, they're going to pay $10 billion. Within 6 years, they're going to pay all the amount, which is $16 billion, if they decide to pay everything to cover their debt. So definitely the debt is sustainable in this particular case. unless something major happens in the future with this company, which is unlikely because company proved already itself for the last many years of its operation. Okay. Now, if we look at price analysis, that's what happens. The way I do it, again, for people who are just new, I put the highest prices and the lowest prices, and then look at earnings on that particular year. And I know that sometimes during that year, people paid for $2.20 of profit, $23. So what I do, 23 divided by 2.2, it's roughly 11. Okay, and sometimes same year, same profit, they pay 37 times. So 37 divided by 2.2, that would be already roughly 16 times, right? So we can see that every year it fluctuates. For the same profit, people within same year, they are paying different amount of money. So what I do, I calculate the average. So I take the average, and average earnings $3.4, average low price $37, average high price $61. So when I divide them 61 by 3, I get the highest average PE ratio. So in general, for the last 5 years, people paid 17 times more for $1 profit. Okay, that's how much they pay, $17 for $1 profit. When everything is in bad situation, it's not that clear what they do. They pay 10 times of their earnings, $10.7 for $1 of profit. Okay, so what we do, if we know that this is the range which was valid for the last 5 years, we kind of expect that it's going to be same in the future. So what we do, we take, okay, what's in the worst case scenario? Worst case scenario, 10.7 times. And what kind of earnings company already has? We know that the company is growing, but let's assume that it stopped growing right now. It's not going to grow anymore. It's going to stuck on that particular level. And how much is going to be? So the last year, the profit, which is based on Valueline, which is actually it varies from the company itself, right? So we see 4.69, so $4.7, right? So we multiply it by 10.7, and it gives us $50. So we assume that if the company is not growing anymore, going to be on that level, and people are very panicking about this company, and they're going to pay only 10 times. So the company price is going to drop to around $50. At the moment, it's 59. So we have this risk of 20% drop. Okay. Now, if you look at another positive side, and the company tells us that the company is going to make $7.2 within the next 3 to 5 years to grow to that level, and when it happens and everything is good, and people again willing to pay more premium for that and pay $17 for $1 profit, so what we do, 17 multiplied by 7, and we'll get $128. So sometimes in the future, we can expect that it's going to be at around $128 price level. So because this fluctuation happens, and sometimes companies closer to the higher level, sometimes closer to the lower level. So what we can expect, 30% here, 30% time here, 30% somewhere in the middle. So that's how we divide by 3 areas, ranges, from 50 to 76. This is the buy range. From 76 to 100, it's kind of hold range. And then from 102 and 28, we know it's already high range where we might consider to sell, unless the company increase their earnings much higher than we expected, okay, if there are some fundamental changes. Okay, this is kind of ranges which we see, and at the moment company is within buying range, so that's why we give it 52 points. So it's like the highest point for undervaluation. So the company is undervalued right now, okay, based on historical performance. Now I put here tangible book value is negative, and the next earnings is going to be sometimes 27th of April or close to those dates. Okay, we have plenty of time to play around with this company if you don't want to carry it over earnings. All right, this is how I analyze the company. This is kind of conclusion I came to it. So, and based on that, we already can make a decision. Now, also what I wanted to show you, the Estimize. This is a website where we can see the expectation of earnings and what actually happened. So we can see a few earnings here, and here green dot is actual performance, and other dots are kind of estimates. So we can see here definitely a company beat their earnings, so they went out of range. And remember when I told you that 8 times of 10 companies right about their earnings. This 1.5 times when they are not right, it could be both way, kind of they over-delivered or under-delivered. So in this particular case, we can see that's over-delivered, here over-delivered, over-delivered, exact, under-delivered here, few cents here. Here it's a bit over-delivered, exactly, right? So 1 cent here is this under, but still in the range. So they've done what they promised, because usually they give you the range. They don't tell you exact number. So it's kind of a range. So they were in the range, but on a low scale. Okay. And that's what the expectation. We can see this volatility on the market. Now, interesting thing, when I went to ownership report, look, guys, what I saw here. Institutional ownership is 253%. I actually was pretty surprised when I saw it, but at least before I would be definitely surprised. But after last masterclass, when I analyzed where, right? Remember, we discovered that only out of all companies, the 85% of the company was company, and those company, those shares that weren't publicly traded. Only 15% of the company was publicly traded. So I presume that similar situation can be with CNC. I didn't see this information somewhere, at least in the sources where I looked at, but definitely when I see something like that, I can assume that this ownership, so part of the shares are not traded on the market, only part of the company is publicly traded, okay, on the company. And that's what we see. Russell Investment Group owns 112%, nearly 13%. Russell Investment Tax Management also 112%. So it seems like some part of the company is locked with those businesses, with those funds, and now not selling it. And actually, for us, for small investor, it's actually a good hint. So if you see that those huge corporations, they own huge chunk of this company, and they even don't consider to sell, that's why they're not publicly traded. So it's actually pretty good for us. It tells us that they definitely put huge amount of money into this business, so we might do as well. All right, and so this is kind of the information. Actually, if you go to FinViews, you can see that from shares which are outstanding, institutional ownership is 94%. Only 6% is available right now on the moment when this FinViews report was issued. Okay, was available, and short float is 1.5%. It would require 2.2 days in order to buy it back. Okay, so something like that. So if the price moves, most likely it's going to move quickly. Even it's not a huge amount. I mean, like 2% or 1.5%. It's not a huge amount. But when you consider the free shares in the market, it's only 6% of the market. So it's actually, they have to buy 30% of existing like free trading shares in the market, which are not bought by institutional investors. Unless institutions that start selling, these guys, they can get into short squeeze, okay, something like that, which recently happened with some companies.